All right, let's go ahead and get started. Welcome to our webinar, our weekly webinar series. I'm Rochelle Wilhite. I'm the designated broker of Best Choice Realty. And tonight we are going to be covering the Form 22AD for Washington State. And I have asked Sam and Ted to join us in discussing from the vantage point of a lender how you utilize these forms. So it does take a bit more education to be able to pull this off and be successful at it. And there are some strategies that we'll discuss tonight that may help you. So before I get started, I just want to welcome Ted and Sam. They did send an email out to all of you that are with Best Choice. They are our preferred lender with Best Choice Realty, and they are very experienced, in fact, very seasoned as well. And very productive. So there really hasn't been a scenario or a situation that I have ever experienced where I did not have a resource like Ted or Sam to contact and say, hey, can you run this scenario? Or can you, what's the industry saying? Or how is that working out with that particular client? Very, very efficient guys, and they do know how to get things done. So we're very pleased to have them join us tonight. So before I turn some time over to Ted and Sam, I do want to give you guys a high level of some of the things I'm seeing from the designated broker and managing broker standpoint on the 22AD and the 22A. If you understand 22AD, you only use 22AD when you have a 22A. I think another broker from another company made that mistake several weeks ago, where she actually thought that the deal that they accepted was better when they used the 22AD rather than the offer that our agent wrote that had no 22A and had no 22AD. In fact, it was so competitive and so compelling that the agent didn't understand 22AD enough, where they didn't realize that we actually were the better offer. We had the escalation that was the highest. We actually had an underwritten approval from a mortgage company like Movement Mortgage that had underwritten all the way through all the way up into basically all you had to do was do an appraisal, and they were putting a significant amount down. And so the lender and I spoke and said, you know what, we don't even need a financing addendum. So we wrote it so strong. And even with that, the listing agent happened to be very naive and very new and did not understand what a 22AD was. They thought the 22AD was better than not even having a finance contingency, which is a complete mistake. So I want to make sure you understand that you only use a 22AD when you use a 22A. If you're waiving financing, if you're dealing with a cash buyer, there's no need to use a 22AD. So I just want to make sure that's very, very clear in your minds. The other thing I want to draw your attention to, and the scenario we're going to go over tonight, is a 20% down buyer or borrower situation. So when you fill out Form 22A and you check the box on term 1A, it's a conventional loan in this scenario, it's a 20% down loan. You really want to make sure that you've had a conversation with that lender and that the pre-approval letter that the lender is issuing matches the 22A that you're putting here. If it does not, then you could potentially be seen as an agent who is not practicing real estate correctly. In fact, you are not communicating well with the parties. So they could put their earnest money at risk. For example, if you said that they had 10% to put down and they only had 5% to put down, right off the bat, right after you go mutual acceptance, your earnest money is at risk. So you never want to be in a position where you have a discrepancy like that. To avoid those discrepancies, you'll want to speak with your lender before you write the deal, before you write the offer, and just confirm your understanding of the pre-approval letter and how much money they have set aside to put down. So that's number one point that I wanted to make tonight. I talked to Sam earlier, and he said that most of the contracts he's seen come through are actually leaving term 11, line 11, leaving that as 5 days, giving that client 5 days, and I call it the shopping clause, 5 days to shop, which, you know what, honestly, if you're working with a crew like Ted and Sam, they don't need to shop. I mean, they are that good at making application and really getting things into a position where they can send it to the underwriter. In fact, Ted, your underwriter's in-house, right? I mean, processing. So, I mean, it's like amazing. You get that kind of service when you work with Movement Mortgage. So I'd like to see it, if you guys are using Movement or using a preferred lender, that you really kind of tighten that down. There's no reason why you need 5 days, honestly, for that client to go shop. You really can kind of help yourself and help your preferred lender by kind of making that a less time. And then it helps you get that appraisal ordered and get on your way by cutting that timeline down. So just be careful. If you're using a lender that you have not used before, you probably want to keep the 5 days as it is. Then you have the section on 22 AD where it's like, okay, the listing agents come to you and said, Rochelle, we're in a multiple offer situation. We realize you're putting 20% down, but we are like not only looking for highest and best, but we're also concerned that the momentum or the escalations might increase that price to a point where I'm not confident that that will actually appraise. And so that's the reason you might use or might consider using the Form 22 AD with your client. That is called an increased down payment addendum, where it kind of is a way where we set the stage ahead of time. We pre-negotiate, if you will, in a situation where the appraisal may not come in at the valuation. And so we pre-negotiate using and modifying the 22A and using the 22AD in conjunction with the 22A in our addendum line. So again, we only use 22AD when you're using 22A or when you're using 22AA, when it's just an appraisal contingency. We don't use it for cash. If you have a situation where you want to prove that out, call me, call a managing broker. We can assist you with that. And certainly we want to understand the forms. So you do need to read and know what you're filling out. So when you look at 22AD, you have two choices. You don't check box 1 and box 2. You need to determine, did I use 22A or did I use 22AA? It's one or the other. So they put it in parentheses. You see that on the form 22AD? They put that in parentheses. So for newer brokers or people who are just coming into the industry, they kind of are flagged on what box I check. So in this scenario that we're using tonight, Ted and Sam, we are basically we're being instructed by the listing agent that we may want to consider using a 22AD to improve our chances of getting our offer accepted. And so therefore, we are going to want to contact our lender. I would give you another tip of the trade for those of you who are maybe newer to the business or some of you experienced agents. Anytime you want to use a Form 22 AD, I would highly recommend, if I could mandate it, I'd probably say that on this call, but you want to call that lender and make sure that they do have the additional down payment available, because again, just like when we talked about earlier on term 1A, if you end up putting 10% down and they only had 5%, they run the risk, or their earnest money is in jeopardy, and they could run the risk of having a problem or being sued if it's not filled out correctly, and you could run the risk of having problems as well. So I would highly recommend you, before you even start typing up this A, B, and C on term 1, that you have a conversation with the lender. So that's what we're going to kind of, I guess you say, role play tonight, is I want to turn it over to Ted and Sam. And then by the end of the call, I want to basically have a conversation with Ted on how I would fill out term 1A and explain that to the buyer, who actually happens to be Ted's borrower, and make sure that we have a full understanding of what we're going to do here. Because what could make a lot of sense and what could get you the deal could be the conversation we're going to have tonight. So with that, I'm going to turn it over to Ted and Sam. Very happy to be working with both of them. Take it away, guys.
Thanks. I'll go first real quick. So I'm looking at the people on this call. There's about half that I have worked with, either done loans with or at least corresponded with. So we sent an email out last week, but email is almost noise. I just want to dovetail on that email. So I've partnered up with Ted. So we are working as a loan team now, and a whole lot of advantages. Ted's volume is off the charts, and there's 3 or 4 of us working out of the West Seattle office now, and there's just a lot of, if you know me, you know I'm pretty understated and not salesy almost to a fault, but there's some really big advantages working with this team now. Just one is the experience and the knowledge of how to put together loans and fix loans. But we also have this set up where a borrower can start to finish, doesn't have to print or ink sign anything. It's all, we make it as easy as possible. Everything is e-sign or DocuSign, and it's filled out ahead of time for them. We order the appraisal day one, which most loan officers can't do. We also have the ability to approve our own rush fees on appraisals, which is also a big benefit. Appraisals are one of the biggest challenges to a quick closing right now. And I could go on and on, but so if you send or receive an email from me or Ted team, it's all shared. So everything goes into one bucket. So we're basically we're a team. So you can ask either one of us a question without worrying if the other one's going to get offended, because it's all in the same bucket. And then so Ted is going to discuss, I think, some of the kind of the quick math on maybe figuring out the 22 AD, and then we'll also go over an example, and then the Q&A. So I'll turn it over to Ted.
Awesome.
Thanks, Sam. Really quick, want to say hi to Yina, who in a past life we worked together at Eagle Home Mortgage. I saw it come through the chat, so I think Yina's in there somewhere. So.
Yeah, Yina's doing a lot of real estate too, Ted. So,
that is awesome.
Yeah.
And so Yina, to dovetail again on to some of Sam's points, Yina actually could give you testimonials on some of the team members that we have outside of Sam and I. We use the same underwriter effectively for every transaction, and that's Helen Kripe, who I know Yina worked with over the years. So anyway, I'll leave it there. What a small world. So in this crazy real estate market we find ourselves in, with very little inventory and buyers drunk on interest rates that start with a 2, it's obviously very tricky to get your buyers into the door. And I see this form as a sticking point on my side of it. When we see successful buyers come in the door, I would say, probably 50% of them don't even have a financing contingency, to Rochelle's earlier point. And I would say 95% of them are representing some short amount that they'd be willing to cover on the 22 AD. And so really all I'm proposing is that whether your lender is Sam and I or a different lender, none of what we're going to talk about tonight is specific to Movement Mortgage or Sam and I. It's third grade math that any of your lending partners should be able to present to you. And basically you're leveraging mortgage insurance and lending guidelines to potentially enable your buyer to come up with and close on a transaction with less money down if an appraisal were to come in well. And so what we're going to try to do is explain sort of under the hood how that might work. And then I think Shannon has a little slide for you just showing one single scenario. So in this particular scenario, I'll just start from the top. Shannon can maybe follow along with her cursor. We have a $700,000 sales price for this example. We have a credit score of 740. And really, we're talking about mortgage insurance here, and mortgage insurance premiums are dictated by down payment percentage. In this scenario, this is a 20% down transaction. Obviously, if the appraisal comes in at the sale price, mortgage insurance is not a consideration. Credit scores play into this. So in this particular scenario, this is a 740 credit score, which is, I would say, in the upper middle of the range. Credit scores for mortgage insurance, unlike in the lending world, can go up to all the way up to 800 in determining that premium. And I guess backing up a little bit, mortgage insurance, traditionally, you might think of, not being a mortgage loan officer, you might think of that as just a monthly premium, an extra fee that's a waste of money, which is all true. But in the mortgage insurance world, there's 2 different options predominantly that the buyer can choose from. There's the traditional monthly mortgage insurance, which we're all familiar with, which generally you're tied to paying for at least 2 years. potentially sooner if the buyer can pay down the mortgage faster. And then there's a less known, what I would call a mortgage insurance buyout or one-time premium. So those are the two general types of mortgage insurance available to the buyer. And sometimes lenders don't present both. And given this crazy market we find ourselves in this 22 AD form, that single premium insurance option becomes very valuable because it basically lets you leverage an insurance premium to not have to come up with effectively that short appraisal amount. So moving on to this slide and the meat and potatoes in it, vertically, I'll just go through each column. So our first scenario here is, okay, the appraisal comes in for our 20% down scenario at the sale price. The customer comes in with that $140,000 needed to close. The transaction moves forward to closing. So, and let's pretend now in these other scenarios that you filled out the 22 AD representing that your buyer would proceed to closing if the appraisal came in as low as $30,000. So anything over that, I don't want to speak out of turn, but I guess you'd have the ability to go back to the seller. Is that right, Rochelle?
Yes, correct.
Okay.
You'd have 3 days in the contract to go back to the seller.
So renegotiate or walk away or right.
That's right. So even if it was 31,000 or 30,500, the appraisal came in, but we already pre-negotiated this, right, Ted? So it's like if we had 30,000 on our 22 AD, it looks like we'd be fine. But if it was even a penny more than that, we could renegotiate. That's correct.
Right. Okay. So we're assuming the 22 AD was filled out representing 20% down, and that the buyer would cover a shortage up to 30,000. It just so happens our appraisal came in right at 30,000, which is kind of a bummer because you can't go back to the seller on this.
Right.
So effectively, that appraisal and this problem resides just with the buyer, you, the real estate agent, and the lender to come up with options given this low appraisal. Mm-hmm. So what we could do is, traditionally, you as agents look at that form and our far right margin there, or vertical section where it says you paid the difference in cash. Immediately, that's what most agents think needs to happen. So you now, instead of needing $140,000 down, need another $24,000, and that mathematically that extra $24,000 is basically 80% of that $30,000 shortage.
Okay.
So I think all of us understand that. And the two middle columns, maybe we'll start with the middle one. This is the traditional mortgage insurance column, whereby in this scenario, the buyer can leverage a monthly mortgage insurance premium and come up with the same amount down, oddly enough, actually slightly less, and I'll explain that, and simply pay a $60.67 premium for potentially up to 2 years, depending on where the market goes and home values go. Oddly enough, Fannie Mae and Freddie Mac give a discount when mortgage insurance is used. So you'll notice that the down payment or dollar amount needed at closing actually went down a little bit, almost roughly $2,000 difference. And in the bottom corner of the slide, you'll see a single asterisk where it says there's a 0.25% lower fee when you have mortgage insurance. So actually, Fannie Mae and Freddie Mac give cash back in the way of a discount to discount points that the buyer would pay of 0.25%. So oddly enough, when you put 20% down, it's actually costing you more money when you're dealing with any bank. And this is across all banks and platforms, this would be the case. So in this scenario, if you took the extra step to quiz your loan officer, instead of coming up with an extra $24,000, the buyer would know and be armed to know that they would simply potentially only need to pay $60.67 per month for as long as mortgage insurance was required. And that could be the difference between that buyer being willing to even fill out the 22 AD and as I'll go into later, we can get even more aggressive with this. But so in the left blue margin, you can also pay really a relative pittance to buy out the insurance altogether. So instead of paying $60.67 per month, you come up with an extra $479 that buys out the insurance and what we call a single premium mortgage insurance.
So do you give this like sheet to the borrower, Ted? You know, if we get into a situation where it's like, oh, the appraisal came in low, even if we didn't have the 22 AD, do you then provide them with some options? You know, like
yeah, I mean, usually with the agents I work with, this would be a phone call that would happen. We get on a Zoom call or we get on a three-way call, and there's a few different breakpoints involved. You know, for this particular transaction, this appraisal could come in as low as $110,000 low. Mm-hmm. And it's really irrelevant if the client has that $110,000 or not.
Right.
It's just the fallout in terms of what that single premium insurance might cost or what the monthly premium would cost. And it's up to the buyer to make a decision as to which one might make best sense. And the final decision can be done later once the appraisal comes in. So just, I urge your buyers, whether it's Sam and I or the lender they're working with, and if the lender they're working with has no idea how to maneuver through any of this, then maybe they need to talk to somebody else because realistically, I feel like that 22 AD sets you apart.
It does.
From the competition. The more aggressive you can get, and you're not really putting your client in harm's way. In this case, your client may not have the extra $30,000, but I'm guessing most of your clients, if they lost out by just not filling out the 22 AD, they'd be more than happy to pay $479 or $60 a month.
Yeah, I agree. So let's go back, Shannon, if you could, to the 22 AD real quick so that we can so in this scenario where it's like, okay, the increased down payment, we're pre-negotiating the situation. I mean, it's great credit score, right, Ted? I mean,
right?
I mean, was that a good or is that great? I mean, where's good and great?
Yeah, so in the lending world, 740 is actually the top of the scrap heap. So whether you have a 740 or an 820, it's all the same. But in the mortgage insurance world, they have a whole separate algorithm. Everything is run through that system. We pull upwards of 10 different quotes, mm-hmm. and depending on a combination of credit score and down payment, that premium is dictated by all those factors together. So it's a tricky one. There's not, unfortunately, back in the old days when Yina and I used to work together, there would be a chart that we could easily look up vertically and horizontally, and we'd say, okay, here's the premium. But in this case, it all has to get plugged into an algorithm.
Okay. So yeah, check the box, Shannon. We're going to definitely check box 1. And then we know from our conversation with Ted that we have additional funds. So when you read this, a lot of people are like, oh, put 300,000. It's like, no, they're not even understanding what this form is about. So that makes me suspect if I'm a listing agent and I see somebody that puts 300,000 in a situation like this, it doesn't make a lot of sense. So with the 30,000, that makes sense because the buyer's lender appraised value of the property is less than the purchase price. Sometimes you may consider, okay, the escalation, it's an $800,000 offering price, but we're $700,000, so we may need to go to Ted and get the pre-approval letter to increase, right? So it matches the purchase price, and then make sure that the additional down payment is properly described as far as what the buyer is wanting to have. Obviously, the sellers are wanting as high of protection as possible. They're using this as kind of like insurance. Like if the appraisal doesn't not come in at $800K and our list price is at $700 and we've escalated up to that, at least the buyer or the borrower is able to come up with $30,000 of additional funds. If I want it, do I want 50? Of course I want 50. I'm a listing agent. I want the whole world, right? So just make sure that they do have the $30,000 money or a way to make that happen if that should occur. We have had a Best Choice Realty agents, actually a couple of you, who have actually just because you need to get this in and turned in, have not called the lender and have improperly written into 1A an amount that has not been verified by the lender. And that's very, very nervous for me and for you when you realize that now we're just waiting around for the appraisal to come in to see if it comes in. And it's a nail biter for sure. And then on the section B, it talks about if the buyer becomes aware, if it's, let's say in that scenario is 800 and the appraisal came in at like 750, and there was obviously we didn't have 50,000 to come in with additional funds, only 30, we would have to give proper notice, meaning I have to send a copy of the appraisal and a copy of the notice form. There's a notice form for that, and it's a 22 ADN. It's 22 ADN if you're using a 22 AD. That notice has to accompany the full appraisal if you are having to go back to the negotiation table. And you only have 3 days to do that. And then the seller has 3 days to determine whether they're going to agree in that scenario where the purchase price was 800 and the additional down we had was 30, but we were still in $20,000 short. The seller would have to agree on the 22 ADN to come up with the 20,000. You guys, the buyers, come up with 30. The seller comes up with 20. We keep the deal together. That's how that section works on the 22 AD term 1C. Does that make sense? Shannon, did I explain that correctly this time?
Yeah, we're good, Rochelle.
Okay, perfect. So I think we've got some questions. We have time for questions, Ted?
Of course.
Okay, let's bring them through. If you guys want to comment or unmute your line, we've got Ted and Sam, both very seasoned professionals.
One quick comment. If someone's doing an FHA minimum down or a conventional 3 or 5% down, you can still do a 22 AD, but every penny that you list on there has to come out of their pocket. There's no room to mitigate it through mortgage insurance. So not having 20% down doesn't mean you can't do the AD, but there's no room to mitigate it with some creative mortgage insurance.
So you really have to work with the lender. I mean, you have to know where that money's coming, because they have to come up with, let's say 3.5% down. Some of that can be a gift, right? But not all of the additional down can be a gift, Sam? Is that what you're kind of meaning by that?
No, it can be, well, depending on the guideline, it can be a gift. But if they're putting 20% down and they're going to do a $50,000 additional payment, they can potentially still get into that house for no money out of their pocket. But if they're doing 5% down and have a 50,000 additional down, that entire 50 has to come out of pocket because there's no room to adjust the loan to value up.
Okay, very good.
You still can do it, but they have to have the money. And
effectively, the mortgage insurance magic, we'll call it, only really works with 10% plus down. And the more down, the more leeway you have on the 22 AD without coming up with extra money. But to Sam's point, if it's minimum down, which is usually 3 to 5% conventional or 3.5% FHA, effectively the buyer on a short appraisal, there's no mortgage insurance that helps them out there. They're going to just have to come up with the difference.
Okay, that's great clarification. Then another question that has come in my text is, what about VA? Can VA do a 22 AD? And the answer is yes, they can, correct? How do you guys?
Yeah, and again, it would depend on the percentage down, and most veterans are going to take advantage of what they deserve with the VA option, which would be 0 down. And in that case, on a short appraisal, they've got to come up with literally 100% of the shortage. So unfortunately, on that scenario.
But there has been some veterans, I believe, that have used the 22 AD and won, but because they actually have a nice nest egg that they've also used, right? Or they have available. And so oftentimes I'm seeing listing agents who are looking at a 22 AD with a VA and just asking for them to prove their funds. That is perfectly fine to do. As a listing agent, you may want to do that if you're concerned about the 0 down and they're using a 22 AD. There's no harm in saying, can we go ahead and can you provide me proof of funds or proof that you have that? And that's just as simply as the veteran, providing the bank statement that shows that they have, the $30,000 in reserves, right? That's available in case the low appraisal comes in. Again, the 22 AD is just a form to pre-negotiate if there is an occurrence where an appraisal does not come in at value. If the appraisal comes in, we're golden, with whatever type of loan that we're doing. Any other questions? Shannon?
So, Eileen has a great question, and Ted, you have a good way to answer this. A buyer who doesn't have the extra down and they still want to do the 22 AD, do they have something to say that MI will cover it? You don't have to show that because they're still putting the same, the terms of the contract are still the same.
Right. I mean, this has come up before. I actually ended up having to talk to the managing broker of one of my clients or one of my agents who's very detail oriented. We went back and forth on several phone calls. And so the concern by this agent, and I didn't see the question, but the concern by the agent was, I'm representing that the buyer has these extra funds, and if the appraisal comes in low, then technically the loan amount, the difference between the loan amount and the sale price, there's that 20% buffer isn't there anymore. But in the scenario that the appraisal comes in low and it doesn't exceed the amount that you've represented on the 22 AD, there's no need, A, to show the seller the appraisal at all because we're forced to proceed to closing. And B, there's no documentation at closing that shows where the appraisal came in, should it have come in low, and you didn't have to go back to the seller. So in other words, the settlement statement simply shows the sale price, not the appraised value and the loan amount. So even if the appraised value came in low, the difference between the loan amount and the purchase price, there's still that 20% buffer there. So you should be good, according to everybody else I've talked to, representing 20% down, even though the appraisal has come in low, because the cost basis for the home between buyer and seller is the sale price, not the appraised value. Hopefully that makes sense.
Yep.
Hopefully I answered the question.
Eileen, just go ahead and give us a okay. And then where do you guys, movement mortgage, I believe, is all over the place. Is that right?
Right.
Or every state?
If we're missing a state, it's very few, and definitely California is in the mix.
No, we're missing Montana was the only state
Okay.
they added that last year. So it's all 50 now.
All 50 states, great.
So,
Fantastic.
so just follow on, this is Eileen. So let's say the buyers, if they don't have the extra down, and the previous table showed basically they can't pay the mortgage insurance in order to get the loan if they don't have 20% down, right?
The appraisal comes in low, if the appraisal were to come in low, the buyer could either A, come up with the short amount,
Yeah.
80% of it in our scenario, because it was
Mhm.
20% down, or B, pay a monthly insurance premium. This is nothing that needs to be disclosed to the seller, as long as the appraised value came in $30,000, within $30,000 of the original sale price.
Mhm.
It's up to us to solve this problem. So
Mhm.
those three options again are come up with the difference, pay monthly mortgage insurance, or pay the single premium. And most people, if they're tight on funds, are going to choose either paying the monthly premium or really the standout in the scenario that we put up on the screen. The $479 was the logical winner because
Does
only
that
takes.
change my interest? Does that change buyer's interest rate?
It
The
does
mortgage
not.
ins- It does
It
not.
does not. It actually lowers their closing costs, oddly enough, because of Fannie Mae's oddball pricing improvement. And Fannie Mae looks at loans with mortgage insurance as more secure than it does with loans without mortgage insurance. So in their view, they feel like they're more likely to get their money back from somebody putting 19% down versus 20% down because mortgage insurance is in play. So their terms actually improve, oddly
I
enough.
see. Okay, thank you.
So what you're really saying, Craig, here is that we're actually hoping for a low appraisal because they could come in at and save $2,000 off closing costs while only paying maybe $400 or $500 for prepay of mortgage.
Yeah. So in our scenario, and we didn't want to go too deep into the weeds, that $479 fee, it's actually to a detriment to the buyer because we factored in the cost improvement to that $479. So we've already compensated them for that.
Oh, so it's $479 plus the $2,000, which
it's about $1,400. Yeah. So the math is, maybe we should have gone deeper into the weeds on this, but the math is the pricing improvement is 0.0025, 0.25% multiplied by the loan amount. So with a loan amount of $560, the buyer's closing costs reduced by $1,400, and the $479 is the net cost after that $1,400 improvement. So the total cost before the improvement, or the total cost of the buyout of the insurance or one-time premium, whatever you want to call it, would be $1,879, and then $1,400 comes off of that because of the improvement that Fannie Mae gives.
Thank you.
I
Does
see.
that make sense? So you really don't want a low appraisal. Unless, I guess, the appraisal came in lower than 30,000 and the seller is willing to play ball and give you a break on the price.
Right.
Oh, so a low appraisal just means you're losing equity because the value's not there. But to Craig's point, somebody who wants to come in and put 20% down, because that's what they've been just entrenched their whole 20% down. We can give them a comparison to put 15% down, and they may like that better. You don't have to put 20% down. I mean,
true.
So you can get the benefit of the lower fee or lower down payment and the lower fee, even if the appraisal is at full value. You don't have to put 20% down. So
I wasn't looking at it that way. So Craig, I guess in a roundabout way, you're right. With that lower appraised value, there is a potential benefit, I suppose.
Trust
depending
Craig.
on how you look at it from a cash flow perspective, right?
That's good.
Yeah.
Good catch, Craig.
Thank you.
Yep. And I like how Sam, you talked about the equity, because I think we get caught up, when we're dealing with our buyers, right? And they've got the house, they're so excited, and then they get the low appraisal, and now we're having this conversation about how we're going to structure things, or we're going to kind of keep the deal together. And I think sometimes we miss the big picture, that really we're talking about potential equity. I mean, it's the equity that's in the house. And that might be a way to diffuse somebody that's really hot-headed about having to come up with additional funds. It's just not all appraisers. I think I've said this more than once. Not all appraisers are made alike. And some appraisers will go out and appraise a certain way. Others will tend to kill the deals. And we've had conversations in past conference calls about that as well, where it sometimes is the luck of the draw, unfortunately, with appraisals and appraisal management companies. And if you're working with a good lender, there's a little bit of control with the AMCs or the appraisal management companies, but not a lot. And sometimes it's out of our control, and we have to basically just kind of keep our buyers and keep our borrowers focused on the prize, right? Which is they got the property and they got a house, and it will start to appreciate over time. Marta, you got a question? Go ahead. What percentage is coming in low? That might be a better question for Jerry K. Jerry K, what percentage of our deals are coming in low? I can tell you that that's probably the number one reason we're seeing cancellations, is because of appraisals not coming in at value. That I can share.
Yeah, we are still getting, I mean, I don't know the exact percentage, but we are still getting tons of low appraisals in there. It's probably 30%. I don't know. I haven't exactly done the numbers.
Yeah,
I don't know.
We're not to like, it's not 40 or 50%, but yeah, I think Jerry K, you're probably close. It's probably 20 to 30%.
Yeah.
Yeah.
So we don't have any actual data either. I would say 0 appraisals are coming in lower than the sales price, but maybe 25 to 30% are coming in lower than the actual negotiated price. Does that sound about right, Ted?
Yeah, that's what we're seeing. Ted?
That 20-30% number sounds pretty close to me.
Okay. That's still very high.
And just one little sidebar. I mean, if your buyer's prepped for these scenarios, it takes tons of pressure off of them when they're waiting for the appraisal. Because I'm sure you have plenty of stress waiting for all these appraisals to come in. But if you have this conversation with your lender, let's look at these 3 scenarios. It takes a lot of pressure off the buyer to know that my worst case scenario is not to come up with $24,000, it's $479. That takes all the pressure off.
Yeah.
But
so
you know,
lender.
too, if you guys are doing your due diligence for your client, whether you're on the listing side or the buying side, you should have already been kind of looking at the comps around the area and seeing what's going on to kind of give your client an idea that it either may or may not come in. They should already kind of know if you're really doing all the work that you should be doing.
No, that's a great point, Jerry K. That, as a buyer's agent, when you're getting into a multiple offers scenario and throwing in a cap price or an escalated price at a certain number, probably should know what that needs to be. We shouldn't be throwing numbers on the wall. There is some logic that's involved in all of this as well. So that's a great point.
One quick question, one quick point. Appraisal. So if if someone's buying a home that's under $1 million and it's a pretty strong file, 20% down, good assets, I'd say, Ted, about a 33% chance that we can get an appraisal waiver in the approval. There's lots of
I just saw
factors.
the question pop up on the screen. It's a really good question about what determines whether or not there is an appraisal waiver. And I can cover that, or Sam, you can.
Well, that's almost a whole nother class, but real quickly, it's a combination of equity in the house, credit score, assets of the borrower, and then the big wild card is how long it's been since the actual property has had financing on it. You may have the strongest borrower ever, but if the house hasn't had a loan on it in 15 years, you're not going to get an appraisal waiver.
Yeah, that's the number one determining factor of the appraisal waiver, is how long ago that property has had financing done through Fannie Mae or Freddie Mac. Because on the lender side, we're simply running the borrower's file through both Fannie Mae and Freddie Mac's automated system. There's no magic to it. We're all going to get the same answer unless we don't run it, or we'll only run one out of the two, which some banks are only approved through Fannie Mae.
There is some massaging. There's definitely an art.
Yeah, right. But if that home, if you have, say, an elderly couple and they've had the home free and clear for 20 years, no matter what you do, you're not going to get an appraisal waiver, because that's the database that Fannie Mae and Freddie Mac holds is the key determining factor.
That's fascinating. That is another call. So we'll keep it moving. I think there's one more, and I'll answer this question, then we'll wrap it up for tonight. Does underlisting the asking price severely impact the appraisal process? So I want you to be very clear that that's a choice that is made by the seller. So underlisting asking price severely impact the appraisal? It could. It really that is only understood once that appraiser is hired to go in and appraise the property. So by underlisting, or maybe pricing, let's give an example of 400,000, and we know that the valuations are coming in from 450 to 500, but we severely underpriced at 400. Number one, we run the risk that the market will switch on you, and so you may have some difficulty there. But will it impact the appraisal process? It very certainly could. I mean, as far as that goes, you could get an appraiser that's looking at different factors and does not take into consideration the multiple offers that came and or arrived at escalated price of, say, 500. So I would say the answer to your question, Childers Davidson Homes, would be perhaps. Does the underlisting severely affect? I would say most likely it would. It's better to go price slightly below market value than to go severely lower, to keep that appraiser, I guess, looking at the right data set. Perfect.
Plus, if you're not there, like Rochelle, our listing that we were just dealing with, if you just allow the appraiser to use their key and walk in and do their own thing, you're not there to really, navigate for your seller. And because I did get asked, what was the scenario? How many offers did you get that came in higher? She point blank asked me, and I was there to tell her what happened.
And if you're not there,
this many offers came in. They all were willing to pay this price, and we just happened to pick the best term,
Mm-hmm.
So yeah, and if you're not there, you can't do that for your client to help the situation.
No, that's great. And we didn't severely underprice.
No, we were right in. I felt
right
really
there.
good, and I based on her her mannerisms and things, I think we're going to do fine.
Yes, well, that's good. But the other thing that could happen is the appraiser could not ask anything and not care. You put this beautiful package together, and we've had that happen as well. Where it's like I showed up, the appraiser was there, and he was a grumpy man.
Yeah.
And so we've had both scenarios. So I think your question's a good one, Childers Davidson, because of the, where do you set your price as a seller, as listing agent? Really you want to look at the marketplace and then look at what what's the inventory like? Is it a market? Is a saturated market? Is it a seller's market? Is it a buyer's market? Or is it pretty balanced? And we are still encountering a seller's market in pretty much all of the areas we service. Not in all. Some of the condos we're starting to see shift right now. And certain areas are certainly seeing a shift as well. So we can't really use general general rule of thumb here, because it's a moving situation right now as we talk.
Sam and I would be happy at some point to get on a call with you guys and talk about appraisals and how they're done and that sort of thing. We'd
Perfect.
be happy to do that.
We probably need to go another round. We had a AMC that did a great job for us that Sam set us up. That was a few months ago, Sam. So we probably do need to cover the appraisal process and how lenders work with us on that. I think we're out of time. So you guys have a wonderful week. Next week, Sam, if you want to join us, we're actually going to be doing the HomeBot demo again. If you want to jump on that, the HomeBot will be joining us to learn about that tool. So if you want to mark your calendars for that, I think you're going to find some great ideas on how to market using great sales data on HomeBot. Okay, perfect. We'll let you guys go. These are recorded. Shannon will send the recording out probably by the end of the week. And have a great week, you guys. We'll talk to you soon.